It is a great pleasure having Russell Napier here. Thank you very much, Russell, for taking the time. You're indeed one of my very favorite strategists. Everything that you write, I have to read. Every podcast that you do, I have to see it. Thanks for taking the time. It's a great pleasure.
Thanks, Ronnie. I'm delighted to be here.
And also, my dear friend Nikolaus Jilch is here. Nikolaus is a researcher at Agenda Austria, a free market think tank based in Vienna, and also a long-term contributor to the In Gold We Trust report. Hi, Nico.
Hello. Nice to be here. Thank you for having me.
Nico, yeah, you started. I think we many years ago, you interviewed me when I was still working in the bank, and you wanted to write a very critical article about gold. And then I mentioned this odd Austrian school of economics, and we talked about monetary history. And
it's all your fault.
Yeah, sorry about that.
It's all your fault.
You swallowed the red pill. Let me do a brief introduction of Russell. Professor Russell Napier is the author of Solid Ground Investment Report for Institutional Investors and co-founder of the investment research portal ERIC, a business he now co-owns with DC Thompson. Russell has worked in the investment business for over 30 years and has been advising global institutional investors on asset allocation since 1995. He is the author of the book Anatomy of the Bear, Lessons from Wall Street's Four Great Bottoms. Fantastic book. Thanks again. And he's the founder and course director of the Practical History of Financial Markets course, course that I will probably attend very soon. And everybody that has attended is that it is something that really everybody interested in financial market has to do. He's also chairman of the Midwind International Investment Trust, a closed-end investment vehicle listed on the LSE, a member of the investment advisory committees of two fund management companies, Cerno Capital and Canox Asset Management. He founded the charitable venture, the Library of Mistakes, a business and financial history library in Edinburgh that now has branches in India and Switzerland. Russell has degrees in law from Queen's University Belfast and Magdalene College, Cambridge. He's a fellow of the CFA Society of the UK and is honorary professor of both Heriot-Watt University and the University of Stirling. He also writes a regular column for the Toronto Star newspaper, and his second book, which covers the events of the Asian financial crisis and the lessons to be learned from it, will be published in summer 2021. So Russell, again, thanks for taking the time. We will talk about topics that we've got in mind at the moment, and I told you before that actually it seems that we're not alone anymore in the inflation camp. We will talk about financial repression. We will talk, of course, a bit about gold, and yeah, I would say let's just jump in. Nico, do you want to start?
Yes, thank you. The main topic, not just for this talk, but I guess for the whole year, is the question of inflation. You've been a deflationist for decades, and you changed your point of view in the last couple of months, I guess. Could you walk us through your thinking? Because I think that's just the main point of discussion.
Yeah, I think decades is right. Actually, I've got just over to my right here, I've got framed a report I wrote, front cover report I wrote in 1998 called Dealing with the D Word, and the D word was inflation. So that's deflation rather. So that was 22 years ago. And, basically in any economic contraction we've had since 1998, the D word, the deflation word has come up, including the most recent episode, but it's now come up several times. You've got to remember that this is exceptional because my entire career before that was to do with inflation. And really since 1958 until 1998, there were no brushes with deflation whatsoever. In fact, I was told by various academics that it was impossible to have deflation. And I say that with a straight face. It was impossible to have deflation because central bankers would always be able to beat it. And we've had it anyway, now admittedly briefly. So after all of this time, why on earth have I changed my mind, which I did last March, April? Crucially, it's because of change in the structure of finance. So it's nothing to do with the change in the business cycle or the levels of stimulus or any of that. It's to do with who creates money, how much money they create, and in whose hands that money is. So for me, the crucial structural change here is that the governments are providing credit guarantees to the commercial banking systems. In the era of quantitative easing, commercial bank credit growth was very low. What everybody who's watching this needs to know is most money in the world is created by commercial banks. They really didn't lend. Interest rates were too low. Regulations were too high. People didn't want to borrow. And basically, the commercial banking system just simply couldn't expand and create money. And then we offered them the credit guarantees from the governments. And now we have across the world bank credit growing really very strongly in a recession, which is unheard of, absolutely unheard of. If we follow the example of the British government, for instance, in the budget of last week, they've now announced credit guarantees on mortgages. Now, that's got nothing to do with an emergency COVID response. And in my opinion, this is the new normal. The governments have effectively, through the powers of regulation, taken control of the commercial banking system. The commercial banking system will lend on demand effectively to what the government wants it to lend to. Therefore, broad money growth will be much higher than it has been in the age of disinflation with deflationary episodes. And it's that structural change that really confirms the likelihood of high money growth and higher inflation for a very prolonged period of time. So something changed structurally, and that's why I changed my mind.
So the main storyline right now is that we'll see a brief pickup of inflation and then see it go away again. That's not what you believe.
No, it really does depend. There's one way I could buy into that, and I could buy into that if what we've witnessed is a pulse of bank credit going out in the emergency, and then it stops, and bank credit rolls over, and with it, money supply growth rolls over. But the authorities have learned their lesson from the last time, and they aren't going to let that happen. And whatever it takes to get the banks to extend credit will be done. I look at the mandate change in remit that the Chancellor of the Exchequer handed to the Bank of England last week, and the Bank of England have to support the long-term asset fund, the housing market, the levelling up agenda, the green agenda. Now, when you give a central bank, and central bank has a role to play in commercial banking, when you give it all these political targets, they are not compatible with the inflation target. So it's not just that we've changed the mechanism through which commercial banks lend, we've changed the policy target of the central banks. And it would be virtually impossible today, given the target in the remit, to say that inflation is still the dominant target for them. So everything is changed on a permanent basis. So I don't believe that inflation goes up and comes back down again, because these are permanent changes in the very structure of how the system works. And I'm sure we'll come on to talk about yield curve control, but that is another one. That's the third one that we're adding into this. Structural changes, not cyclical changes. Therefore, structural changes are sustainable, and you don't get a cyclical uptick in inflation, you get a structural uptick in inflation.
So I think those credit guarantees that's really a topic that you were basically the first talking about that, and that was the reasoning for this shift from a deflationary or disinflationary environment to inflationary environment. But Russell, what would you say those additional topics, like MMT used to be something for left-wing economists sitting in their ivory towers. Now it is really something that is going mainstream. Topics like average inflation targeting, topics like let's say the demographic change. Then of course I think it's really fascinating to follow the exchange value, US dollar versus the renminbi. We saw enormous strength in the renminbi since the end of May, which also, from my point of view, is some sort of an inflationary driver. So those other topics, do you think they just add to your main case, or should we analyze them separately?
No, I think they add to the main case. And what I think is really interesting about all of those that you mentioned is they're all structural. Again, this is the crucial thing. You know, in a career, you can usually, sometimes you can go a whole career and just be guessing the business cycle. And that's a game you can play, and you can play it profitably. And then sometimes you'd have to live through a structural change, as you say, the legitimization of MMT, the politicization of central banks, credit guarantees. I mean, it just comes in an absolute flood. And this is clearly a very big structural change. And when you get one of those, most people are entirely unprepared for what happens next. Because remember, people who are successful in our business have been people who have played a disinflationary trend for 40 years. And they've played a system which was a market-orientated system. And now they're in an inflationary, less market-orientated system. And the skill set for that probably needs to be entirely different. And what very rarely happens is that the revolution of the mind never catches up with the revolution of money making. So most people in the markets are stuck in that. Now you might say, well, I'm one of them because it's been my career as well. But one of the advantages perhaps I have is an understanding of financial history. And I think this period we are moving into, and all of the things you mentioned there, really that is the 1945 to 1978 settings. So we can go back into that period and look at the consequences for investors of these sorts of policies. There's a very different structure of a market before. But what I thought was particularly interesting about everything you said there is it represents a change in the zeitgeist. Savers have done too well. Debtors are overburdened. Money has to be moved from one to the other. And there's very little in the political circles or central banking circles that will push back against that. The zeitgeist is simple. It's the savers who've got all the money. The money has to come from the savers. Now, you can do it directly through taxation, or you can do it through that other form of taxation known as inflation. So the zeitgeist has changed. That's why the structure changed. And everything you mentioned is good evidence of that.
So are you basically saying we're going to see a replay of the 1920s, where first everything, it feels good, everybody thinks they're getting richer, but they aren't?
So I don't think it'll be along those lines. I mean, it depends where you were in the 1920s, obviously. If you were in Germany in the 1920s, or whether in America in the 1920s, I mean, that's a good example, isn't it? America had deflation, price stability, but actually in many goods deflation, and Germany had hyperinflation. What was the difference between the two? It was primarily the rate and the growth of money. There were massive technological breakthroughs after World War I in terms of electrification, the internal combustion engine. All of these things were desperately deflationary. The death of the horse was very deflationary. It freed up lots of agricultural land, which went into production of food for people. But if you lived in Germany or Austria in that time, monetary policy was able to more than offset this. I think it highly unlikely that we go to hyperinflation in this setting. I think it likely we go to reasonable levels of inflation, but the crucial thing is that interest rates wouldn't be allowed to reset to reflect that inflation. I think that's the most important thing for savers. So depending on which 1920s you think we're in, I don't think it's the German or Austrian or Hungarian 1920s, nor do I think it's the America 1920s, because we're going to suspend the free market in government debt. And that ultimately will be the most important thing for investors during this period.
So basically, you're saying that the inflation will be global?
Yes, I think the inflation will be. I mean, every developed world market has got really high levels of broad money growth without exception. I mean, there aren't any exceptions. And when I say really high, triple the rates of a year and a half ago. And if we aggregate them, we are looking at the fastest growth in broad money globally since 1988. And if we go all the way back to 1980, there have only been 6 months where it's been growing faster than this. So it's very clearly a global phenomenon in the developed world, but not necessarily the emerging world. But the point is, if the developed world creates that much money and inflation, it is really very difficult for the emerging markets to remain immune to higher inflation.
But you did mention the technical breakthroughs 100 years ago after World War I. And there is no shortage of technical breakthroughs now. There is technology, and technology is still deflationary. Will that have an effect?
Well, that's kind of why I mentioned Germany in 1923, because Germany also benefited from massive technological breakthrough. But somehow, just by the power of the printing press, we negated those. I would say the real acceleration in deflationary forces began in 95 and the world begins to change in 1995. Interestingly, that's when US equity valuations seem to move to a permanently higher level. Two things happened in 1995. China had devalued its exchange rate in 1994, and it was now selling at much cheaper prices and obviously mobilizing hundreds of millions of people to get productive. And also Jeff Bezos sold his first book in 1995. So where's the birth of the technological revolution? Well, it's always with us, but maybe it accelerates in 1995. Well, I looked this up last night, actually. What has happened to the price level in America since 1995? It's risen 75%. I think we all recognize the scale of the deflationary forces that have been ripping through the world since 1995, and yet prices are 75% higher based on the CPI than they were in 1995. Now, that's actually not a lot over all of that period, but it's still a 75% increase. So somehow in the teeth of the biggest technological acceleration I think the world has ever seen, and in the teeth of the biggest mobilization of underutilized labor that the world has ever seen, certainly at least since we opened up America, in the teeth of both those things, we push prices up 75%. So there's something else going on in the world of prices rather than just technology and just China. So it can be done. It has been done, and it'll be done again.
Russell, you worked in Asia for many years at CLSA, and I think when we had a chat, I don't know if it was at the conference in Monaco where we first met, you said that another driver for our inflation topic would be, I think you said, a proper Cold War between China and the US. I think this is perfectly playing out. It seems that it's not getting better now with Joe Biden sitting in the White House. How strong is this effect of China becoming more and more of a real competitor to the US when it comes to technological things, military, and of course, especially the economy?
Yeah, I think it's very powerful. I mean, the last question was about technology, and I brought China into it because I think it's been both that have given us this prolonged period of disinflation and deflation. What Trump could do would be attack China, but what he couldn't do is contain China, because to contain China, you need a coalition, and that coalition has to include Europe. And Trump was unable to build coalitions, even with his wife, I think we could say safely. I mean, he's not very good at building coalitions. The Biden administration, whether it builds a coalition or not, has a much better prospect of building a coalition to contain China. And that containment must be about containing its external accounts, containing its ability to export. I don't see any move back from this Cold War that we're going into. And I really, obviously, as a citizen of the world, hope that's wrong and that we don't. But that was a massive deflationary. I mean, I looked just a few weeks ago, and I think it's true to say that the price of Chinese exports hasn't really changed in nearly 30 years. It's astounding. I mean, look back at a period of history. You basically have to go back to the gold standard to find a period where a major exporting country didn't get any rise in prices. And you can look at the price of Japanese exports or Taiwanese exports or Korean exports, and you tend to get the same thing. And that was all to do with China. So I don't have any doubts that as we contain China, and that will focus on its exports as well, that the major deflationary force that was China will begin to move into the background. And that's even true if they have to let their currency float, which I think they probably will. It would initially go down, but it would just attract even more tariffs and even more protectionism if the Chinese exchange rate went down. So this Cold War is very, very inflationary, not just because we seal off that production, but it starts an investment boom on an unparalleled scale, because the other side of the Cold War has to begin to build all this capacity that China is not providing to the world anymore. So it is very inflationary. I always begin with the proposition that inflation is everywhere and all times a monetary phenomenon, but I'm very happy to discuss real effects as well. And this China ostracization is clearly one of these real effects.
Isn't it a bit ironic that now the People's Bank of China is running some sort of a conservative monetary policy, and you kind of get positive real yields there. And I hear from many investors nowadays that they are really considering buying into the Chinese bond market nowadays. And it seems I've only read a couple of reports about that they now seem to let companies go bust. So it seems that to some degree they're even a bit more market orientated than we in the Western world.
So I think it's one of the biggest wealth traps ever is buying Chinese government bonds.
Okay.
There'd be two reasons for that. One is in a Cold War, it would be illegal, just to point that out. I mean, lending money to the Chinese government to build aircraft carriers would not be legal in a Cold War. And of course, that's slightly hypocritical given how much money the government of China lent to America to build aircraft carriers. But hypocrisy's got nothing to do with geopolitics. So there could be a situation where you're simply not allowed to do that. I mean, we get people protesting all the time now. Why wouldn't I stand outside a fund manager's office and protest if he held Chinese government bonds, given that money is directly financing the suppression of the Uyghurs? You know, I just think it's going to become a very difficult position to maintain that I fund the Chinese government. And as I say, it's hypocritical, but it's there and it's going to become an issue. But there's a much bigger issue as to why I think it's a wealth trap to put money into Chinese government bonds. China's debt to GDP ratio is just as bad as America's. It isn't this wonderfully ungeared economy. It used to be before the GFC, but it had, prior to the COVID crisis, had the fastest rising debt to GDP ratio ever seen in history in a major economy. If we look at its debt service ratio, which takes into account interest rates, it's the debt service ratio of the private sector. It's got one of the highest in the world. I'm not singling China out. The entire developed world has to inflate away its debts. The only emerging market that has to do the same is China. You don't want to own bonds in a country that has to inflate away its debts. Now, it's currently constrained on that because it's managing the exchange rate, and that does constrain how much money you can create. And Chinese broad money growth is only at 10.10%, slightly above Japan, below Europe, half of America. But they'll have to change that. And they're currently in a debt trap. And to get out of the debt trap, they will also have to inflate away their debts. So to buy government bonds, you clearly don't believe that the government will ever come and inflate away your debts. But it seems as likely in China as it is in Europe, as it is in the United Kingdom, as it is in the United States. So I strongly, strongly recommend people not to invest in Chinese government bonds.
When you talk about inflating away the debt globally, what does this look like? What does this mean for financial markets and for the everyday lives of people?
So this will surprise you to hear that actually for the everyday people, it's pretty good. For savers, it isn't. So let me explain. There are two things you have to do to pull this off. You have to create a high level of inflation and a low level of interest rates simultaneously. And anybody who's watching this, who's been to business school, will tell you that's impossible. Because in a free market, we would all demand a very high level of nominal rates to compensate us for existing inflation and expected inflation. So the only way you can actually pull that off is to suspend the free market and interest rates. And I would argue strongly that's what the European Central Bank has announced today. It has said in roundabout terms that it's going to be capping the yield curve. There's a more accurate speech by Fabio Panetta of the ECB board last week saying that no, it's even better than that. We're going to anchor nominal yields and we're going to drive inflation above that. So that's exactly how you inflate away debt. Just let me give you some historical examples. By the end of World War II, both France and the United Kingdom had very similar levels of government debt to GDP at about 280%. By 1980, the United Kingdom has taken it from 280% to 50% of GDP. And it has done that by pretty constantly keeping inflation slightly higher than interest rates. But it took a long time because there wasn't a big gap till the 1970s. France achieved exactly the same thing in 5 years. And the way France achieved it in 5 years is that interest rates were about 5% and inflation was 50. Now, in that environment, you can wipe out your government debt very quickly indeed. I don't think anybody will contemplate that. I think the dislocation and destruction of wealth will be too great. So you take your pick. Is it going to be the French approach or the British approach? But either way, the only way you do it is to keep inflation above bond yields. And if it's just a small gap, that goes on for decades. And if you're prepared to live with a very big gap, that goes on for much longer, or a much shorter period of time. It doesn't surprise me to know that the biggest advocate of inflating away debts is French. He's called Piketty. So There may be, I don't know if that's a coincidence or not, but France historically has been quicker to grasp the power to inflate away its debts. It's fascinating because it's given away that power, technically given away that power to a European Central Bank. But the European Central Bank is, of course, run by an ex-French finance minister, so this could come in useful.
Well,
sorry, go ahead. I think it's pretty interesting to see that non-economists are now the heading the ECB, but also, of course, the Federal Reserve. And I think the symbolism or the symbolic character of Janet Yellen now becoming the Treasury Secretary as a former Federal Reserve head, but also Mario Draghi, former head of the ECB, now becoming prime minister in Italy. I think this is a perfect picture and the perfect confirmation of this marriage that fiscal and monetary policy has made recently. But Russell, what I wanted to ask you is, I think that we haven't talked about the Austrian School of Economics so far. We are both from Austria, and we very much adhere to some Austrian thoughts. I think you probably also have some sort of sympathy for Austrian ideas, but having a look at markets at the moment, we're seeing basically that everything is rising. We're seeing all-time highs in basically every asset class. I just saw that NFT, which seems to be the next big thing, not non-fungible tokens. There was a picture or a kind of a painting sold for, I don't know, 60 million, something like that. We're seeing that in the equity market, stuff like the specs, and we're seeing developments where really lots of retail money is coming into markets. We're seeing that commodities are now really surging. Are you familiar with the idea of the crack-up boom by Ludwig von Mises? In German, the term is Katastrophenhoch, which is really a catastrophic boom. Would you say that we're like at the beginning of this move where people really lose confidence in paper money and just want to get as much real assets as they can get?
Yeah, so I have great sympathy for the Austrian school, but and it's a big but, because I'm a Calvinist, you see, and therefore it strikes one straight as a moral code. It strikes one as an incredibly moral thing that those who do things badly get punished and those who do things well get rewarded. But I see absolutely zero evidence of it in the post 1929 setting. You've got to remember that what changes in 1929 is not the gold standard. What changes in 1929 is we become a democracy, and we don't have democracies until then because women don't get the vote. So when women get the vote, we become democracies, and democracies cannot live with Austrian economics or the consequences of Austrian economics. So I do realize we're going to start a big debate on that and a bit of pushback on that. So I have never actually analyzed, and although I have the sympathy for it, I've always looked at it as from a monetary perspective, because I know that central bankers will do everything in their power possible to stop the powers of Austrian economics. Now, I also would agree that eventually that just takes you to a huge catastrophe if you constantly do that. But let's be clear before I do the timing of this catastrophe, let's be clear what it takes you to. It doesn't take you to everything getting wiped out. It takes you to the government running everything. That's what happens in a democracy. The government takes over. And it's not that everybody gets wiped and there's some great Austrian clearing. It's quite the reverse. It's that even more market forces are suspended, and you go into even something even more that's like a command economy than it was before. So I realize that's a disagreement with the Austrian school. I'm afraid it just doesn't happen because the political consequences are so great. So that's what I'm really concerned about is happening in, well, everywhere actually, but particularly in Europe at the moment, that we're just slipping into this thing where the government and the central bank will control all the variables. And that seems to be what is going to happen. In terms of where are we in the money has no value, we better get out, there's actually quite a long way to go. There really is quite a long way to go in that. I'm one of those people who speaks to the market every day. There's certainly no great belief from most people that inflation is getting out of control. Even inflation at 4% historically doesn't send anybody rushing into real assets. We had inflation at 4% 3 times now in the last 30 years, and it didn't send people running into real assets. You really need a level of inflation much above that. I think we'll get there at some stage in this business cycle, but it's not imminent. So in terms of real assets, we're probably in the early days. Now, SPACs and tech stocks, those are not real assets. Those are something entirely different. So that bubble, that bubble may be at its peak. I think these are incredibly difficult things to work out. But the so-called bubble in real assets, actually, I think it's just beginning rather than ending. I think it's got a long way to go. I've got on my desk here, actually, this is 1902. This is the last time the British government ever put out a 1-ounce silver coin, 1902. That's how long it's been since we lived in a world of real money. It's a long time since we've had it. And as long as we continue not to have it, and we won't, the value of real assets can go up a hell of a long way from here. So I think that's really only just begun. By the way, I prefer these to Pokemon cards, but Pokemon cards are going up even faster than 1-ounce pieces of silver. So
it's not an ounce piece, but I do have Austrian shilling coins from 1974. They were made out of silver until 1974 here, and now they get bought for their material value. So
can I just interrupt, because I have an Austrian one here as well, which you'll probably recognize. So this will bore everybody, but this is a Marie Therese Thaler, which is a 1-ounce silver, and you probably know that these are still made.
Yeah,
there's lots of reasons why they're still made, but one of them is that they still circulate as currency in the Horn of Africa, where this is still a store, not only a store of value, but a means of transaction. And I was lucky enough to have lunch with Sir Bob Geldof a while ago, and I showed him one of these, and he said, "Yeah," he said, "they're all over the Horn of Africa. I wonder why." So this has maintained its value, even as a means of transaction, I think since 1782. Not a bad record for a piece of silver.
But I can pick you up on that, because the Austrian mint, where the silver piece and the gold philharmonic are minted, is owned by the central bank, and the central bank is part of the euro system. The euro system has 12,000 tons of gold. So what do you think is the role of gold within the monetary system right now? Why do they own the gold? What's the plan there? Do you think there is a plan?
No, I don't think there's any plan. I think it's a legacy of that's where reserves were historically in. Some people, like the British, sold their gold, but most people just hold it as a legacy. I don't think there's a great deal of planning on this. There certainly would be no plan to go back to a monetary standard or a gold standard in a democracy. That would only happen after a hyperinflation. That's the only way we're going back to the gold standard. Democracy, in my opinion, is incompatible with hard money.
But do you think that there's a possibility that elements within the central banks realize that they need to open avenues for normal people to run away from the inflation in some way?
No, I think exactly the reverse. I think there'll be. I mean, if you're going to inflate away debts, the most important thing is that there is nowhere for someone to hide. There is nowhere to run away. And you certainly don't want to open an official channel. I mean, there are places to run away. There are countries that won't do financial repression. You can buy silver, you can buy gold, but the idea of opening an official channel to do it is somewhat unlikely. I mean, I buy gold from the British Mint, so there's currently an avenue to do that. That may be restricted in terms of annual production or something like that. But I think it's a great question, because it raises the issue of crypto and Bitcoin, which nearly everybody who's buying thinks it is a way that you can escape financial repression. And the answer is it can't be, because if it is, then everybody will use it and you can't do a financial repression. So a repression is really about closing all these loopholes and putting fish in a barrel. I mean, if you want to shoot fish in a barrel, you first better put them in the barrel, not offer them an escape route. So tightening up all these controls is really the first place you go as a government or a central banker, rather than opening up more loopholes.
Well, I think you once said that financial repression is the art of stealing money from old people slowly, something like that. Well, I mean, your scenario of, I mean, we already have quite a lot of financial repression. I mean, as an asset manager, I mean, it's for us basically in a UCITS fund, it's basically impossible to hold physical gold, but it's perfectly fine to buy Portuguese debt at negative yields. But gold obviously is too risky in the eyes of regulators. However, don't you think that if we see financial repression like you see it, like really much more dramatic than we have it now, wouldn't that have to go hand in hand with capital controls?
The answer to that must be yes. So I always give you very long answers, Roddy, but the answer to that must be
Okay.
Yes. We really haven't had a financial repression without it. So then let me lengthen the answer a little bit. It could be a different form of capital control. So it may not be a capital control that stops you crossing the border with money in your pocket. It could be a different form. And the form is that you just really so strictly regulate your financial institutions that they can't take any money out of the country. Now that may be sufficient and it may be insufficient, but it's where you can start. And it is worth going back in history. We take it for granted now that most wealth is held in regulated financial institutions. But if you go back to the end of World War II, actually, most wealth was held in the name of individuals. And therefore, to stop money going out of the country, you had to really tightly regulate even individuals. In a modern world with so much of it held in regulated financial institutions, it may be possible to do what are actually capital controls just by under the guise of macroprudential regulations. So if I lived in Germany, they would say, look, you can't, no institution can own gold because it's too dangerous. No institution can own equities because it's too dangerous. Now that is a capital control, in my opinion, but it doesn't get called that. It gets called macroprudential regulation. So the simple answer to your question is yes, but it may come in a different form.
But do I understand correctly that you do not see the broad equity markets as a way to get away from financial repression?
So yes, components of the equity market, yes, but this is the main problem I have with financial repression. It ultimately involves forcing savings institutions to buy government bonds. You really can't continue to do it using the central bank balance sheet because you'd be creating too much money. And if I say to, let's pick a German fund and say you must have 75% of your money in German government debt, well, they have to sell something. And I think what they sell is equities. It's one of the things they sell. It's not the only thing they sell. So that would be the first thing. If we go to that form of repression, you've got this prolonged sale of equities. Having said that, the beautiful thing about equities is there's so many of them and so many different types of companies. And there are bound to be companies that will benefit from high inflation, which means high selling prices, particularly if they have high fixed costs, such as depreciation or interest expense. So it would be impossible to dance in and out of the bond market to defend yourself from repression. It may be possible to take positions in the equity market to defend yourself from repression, even though equities generally would be going down. The first rule of repression is get your money out of the country.
I think it's we published this report about inflation called "The Boy Who Cried Wolf," and I think it's interesting. I had a look at the Bloomberg forecasts for inflation. So the most important economists say for 2021 they forecast 2.3%, for 2022 2.2%, and then it should fall slowly to below 2% again. So this would be the, let's say, the feel-good area for equities. But at 2.5, 3%, something in this area, this feel-good zone is ending, and it's ending quite abruptly. So I think it's important also to stress the point that equities per definition aren't the best inflation hedge. It really depends on the sector. There's a great article by Warren Buffett, how inflation swindles the equity investor. But Russell, so if we see rising inflation, and you're not talking about hyperinflation, but I think something around 4, 5, 6% should be possible from your point of view. So a large part of the equity markets won't do so well. Bonds will have a hard time, obviously. So what's actually left besides real estate and perhaps gold?
Yeah, I think we need to talk about that in a bit more detail. Normally, growth goes up, inflation goes up, interest rates go up, and equities go up. That's the normal situation. When you look at historically, basically inflation can get until 4% and equities just keep going up, even though bond yields are going up. So that's the normal scenario. And obviously, we're quite a long way from that. So that would say just hold equities until we get near that level. But, and I think it's a very big but and the most important but, and we've kind of already discussed it, would we ever allow the 10-year bond yield to reflect those levels of inflation? And that's the important thing. So you pick a number of, you just mentioned that some of these analysts are forecasting 3% inflation 2 years out. Where would bond yields be at 3% inflation? Now, even if you think it's going to roll back over until 2, surely you're going to be saying that Euro bond yields should be at 3, 4. Well, actually, they're going to be at 0. Because today the central bank just told us they're going to stay at 0. I mean, they categorically said the yield curve staying where it is, ain't going anywhere. Now that's different. That's not what we expect to happen. So, it was really back to that previous question. What does that mean? Because this is completely different from anything we've ever seen before. And we've already discussed whether that's positive or negative. In terms of where you put your money, though, why don't we just find a country that hasn't or doesn't financially repress? After World War II, that was Switzerland. For a very good reason. Switzerland ended World War II with not very much government debt for reasons that everybody knows. It didn't have to inflate away its debt. And one of the simplest things you could have done as an investor in 45 was put your money in Switzerland and go to the beach for 40 years. That was kind of all you really had to do. I think the emerging markets, and this is obviously contentious given we associate them historically with more risk, that the emerging market ex-China debt to GDP ratio is 166%. The developed world is 300%. France is 371%. So I think emerging markets, gold, which I know you would like to talk about, gold is definitely somewhere you put money in a repression. But if you get stuck inside a repression, residential real estate actually is another place where you do quite well. The price of the residential real estate may only rise in line with inflation. So you might think, well, I'm not actually protecting myself. But obviously, if you've borrowed heavily and interest rates don't go up, then you benefit from that. So there are some places where you can cover yourself from this, but a lot of them will be outside the repressionary regime. If you get stuck inside a repressionary regime, and I'm using the word stuck because we mentioned the word capital controls, you've got to run very, very hard to stand still as a saver.
But don't you think that investors and people running businesses are always one step ahead of government actions, that they anticipate future financial repression, capital controls?
So
I mean, that's already happening probably.
Yeah, you're right. My definition is stealing money from old people slowly. So the idea is that you do it slowly enough so that they don't notice. But at some stage they notice. It's a really interesting point. Have they already noticed? Not really. I don't think so. I mean, money is, you probably have a lot of friends who are doing that with their money, but the big institutions aren't. Mm-hmm. So it's when the big institutions start doing that. And I don't think it's really begun yet. So I think it's absolutely right. You try to do it slowly, and at some stage the people work it out. And what you get then is a collapse in your exchange rate because they rush out of your exchange rate. Now I'm watching the euro trade today. The European Central Bank has categorically told people it's going to inflate away their debt. It's a target of the ECB to inflate away debt, and the exchange rate went up. So clearly, markets take a while to work these things out.
One thing we never had before is the thing that we're using right now to talk, and that's like a global network of information. I don't want to get into too many details on Bitcoin. This is not a Bitcoin discussion, but what is happening in the Bitcoin circles right now is that there are thousands, tens of thousands, maybe hundreds of thousands of young people talking about exactly this, getting out of the inflating fiat money system. So even if Bitcoin disappears tomorrow, the idea of why you need it doesn't go away. We just talk about why we're needing it. So my question is it possible that the information travels quicker than before, and that people react quicker than before?
Yeah, so one of the problems I have as a financial historian is to believe that people get smarter, because I don't really see a lot of evidence that people get smarter. When I look at all the mistakes that happen in this cycle, they seem dramatically similar to the 1866 cycle. So I don't base a lot of what I'm saying on that. Information is quicker and people are smarter. Probably quite the reverse. And I've written an introduction to the modern edition of The Extraordinary Popular Delusions and the Madness of Crowds, suggesting that because we believe so much in our intelligence these days, that we have a false certainty. And it's when that false certainty ends that things can be even worse than they were in the old days. And we have bigger groups now. And that was another thing I'd point out. What you're suggesting is the group has become even bigger, and groupthink is a well-known phenomenon. So the ability to do groupthink is on now a global scale. So I wouldn't say that. But back to your, the key point we keep coming back to here. There are two sets of money. You mentioned all those young people. Well, they're acting with their own money. Actually, they're acting quite a lot with government money and stimulus checks. But anyway, that's now their money. And then there's the institutions. And this is the interesting thing. I see, you'll see with a lot of your friends, people moving money because of this, but the institutions can't. They simply can't. So if they, let's say they represent 80% of the liquid wealth of an economy, and I made that up, but let's say it's 80% of the liquid wealth of an economy, they're going to be trapped. So I think anybody watching this will conclude that one of the most important things is not to have your money in a fully regulated, if that regulated entity already has its money in gold, if it already has it offshore, then fine, that's not a problem. But a regulated entity with its, holding domestic assets is going to find it very difficult to do what all those young people are doing and trying to escape this system, because if they can escape, then you can't inflate away your debts.
Russell, I would like to touch on a topic that is slightly similar. I think Hayek would have said it's a bit of a weasel word. Back in the days, everybody was talking about the SDRs, and a friend of mine, Peter Miller, once said, money used to be I owe you gold, then it became I owe you nothing, and the SDR would be a who owes you nothing. And I think that this trend regarding CBDCs, central bank digital currencies, it is coming kind of on the back of the whole crypto trend, obviously. But do you think this is something that will be implemented at some point? I mean, there was the Bank for International Settlements coming out with a big paper that was backed by all the important central banks, and it is definitely something that the ECB is also considering. Wouldn't it be fantastic if you have a digital account with the ECB, you have your e-euro, and then you just charge, deeply negative rates like Rogov suggested. So what's your view on this CBDC thing?
Yeah, so I think this is the same Peter Miller that I know from Speyside in Scotland. And last time I saw Peter, he was removing a fishing hook from my face. So I owe him a great deal, not just for monetary and financial advice. Yeah, so what people need to look at is the BIS has published a paper on crypto not long ago. And to show how important it is, it was presented by August Carstens, who's the head of the BIS. So clearly they think this is important. I think there are two key conclusions that he points out. First of all, private sector crypto is very dangerous for the banking system. It's a way for the banking system's funding in the form of deposits to start disappearing. So they have to look at that from a financial stability perspective. You'll know there's legislation before Congress to track who owns crypto. So, that's not to ban it, but to track who owns it. I think that'll put people off it. So I think, the central banker is very concerned that crypto can undermine the entire stability of the banking system. So I think we better pay attention to him. Now, the second thing is what you mentioned is that the central banks themselves can develop their own crypto. Now, that's obviously a very different thing, because if money starts leaving deposits and going into the central bank's crypto, the central bank lends it back to the commercial banking system. So it doesn't ultimately become a destruction or a run on the bank. However, what it does do is the role of the central banks, or the intertwining of the central banks with the commercial banks, goes dramatically higher. That the two become completely entwined. And Hayek, I don't think Hayek would like that. But anyway, that is what happens if you produce too much of it. So it's interesting because Carsten says when we build this stuff, we better constrain the supply of it, because we don't want a situation where we're effectively owning all the deposits and giving it out to what, these things wouldn't be commercial institutions anymore. They'd be deeply politicized. So, my conclusion from that, and it really is based on Carsten's paper, is they will act to constrain the supply of crypto. They will create a digital central bank currency, but they'll be very careful not to make it too big, in case too quickly it just strips all of the liabilities in the form of deposits out of the commercial banking system.
Makes sense. We have only briefly touched the topic of gold. Russell, in summer it was really easy to be a gold bug. Now it seems it's the most hated thing. I'm getting emails and phone calls from many people being a bit worried about the price of gold. Obviously, I mean, yields are up since summer. I mean, it was a big move. Although the absolute level still is fairly low. I think that crypto, or especially Bitcoin, stole a bit of the media attention from gold. But what's your case for gold going forward? I mean, you obviously we don't have to talk about price forecasts, but where do you see gold in the portfolio, as you know, from an asset allocation point of view? What would you think for an average investor should be the allocation?
Yeah, so just to prove that I don't just specialize in silver, there's my British sovereign, my little tiny piece of gold, which can still buy dinner at the Savoy, apparently, though I'm not the sort of person who goes to the Savoy for dinner. Financial repression. So what we've had initially is interest rates going up, and the relative yield of gold has been hit by that. Obviously, gold doesn't have a yield, but it's been hit. The crucial thing now is, do we cap interest rates? Because that's when everything changes. If we just stand back and maybe bond yields go up and up, maybe there's another 100 basis points where gold doesn't do well. Because people move out of gold and look for that yield. But if we cap yields, then everything changes. And obviously that's what happened today. The ECB announced a yield cap. Because now what you're told is, it doesn't matter. I mean, this is for European bonds. It doesn't matter what your nominal yield is. You know it's going to be below inflation. So why on earth would you take that nominal yield, which is still in many cases negative? So you have to reconsider. And you have to reconsider gold. And the reason you reconsider gold is one of the best relationships is real rates over the long term. And the central bank just guaranteed you negative real rates. That's actually their target in the European Union. And then it goes to the second level, which we have discussed throughout this conversation, which is macroprudential regulation, trying to force you to own things you don't want to own. So it's not just that, hey, there's negative real yield curve. It's just a massive control over what you're allowed to own. And the beauty of owning one of these is it still goes into your jacket pocket if you want to go from Italy to Switzerland. So it is still bid up. So it's bid up, if you like, because of more government control. So it benefits from both.
Makes sense. We're already coming to the end. Nico, do you have a question? Final question.
Well, to be complete, we do have to ask you for your case against Bitcoin, because all the roles of gold that you have just described are fulfilled by Bitcoin right now. It's even easier to cross the border. So how do you think, you think it will end badly? How would it look like?
So if I put the two assets together, Bitcoin and gold, and then I work out what I would call anonymity value, which is the value of nobody knowing what you're doing with your money. Actually, in gold, it's relatively low anonymity value because most of it is tracked. Most people know where it is. The people who buy Bitcoin, who I speak to on a regular basis, tell me they have complete anonymity and no one will ever be able to find them. So I don't know what percentage of the total value of Bitcoin is anonymity value, but it is a very, very high percentage. Now, let's say that Congress passes this piece of legislation, which was interestingly introduced by the Republicans, introduced by Trump before he left. One of the last things the Mnuchin signed was this piece of legislation to track who owns Bitcoin. What is the percentage fall in Bitcoin the day that you know that the government can track it? So I prefer Pokemon cards to Bitcoin because the government isn't going to be able to track your Pokemon cards, but it is going to be able to track your Bitcoin. So there's not a lot of anonymity value in gold, and that is why the relative case for gold versus Bitcoin. If Bitcoin stays an open black hole through which people can escape taxation, regulation, then that will be kind of the breakdown in Western society. And that's why it's not going to be allowed to happen. If anybody chooses to take their money into a deep, dark black hole where they're not subject to taxation or regulation, then society collapses. So it's not going to be permitted.
But gold will be permitted, is what you're saying, because there would also be a way to escape financial repression. And you said that the government will shut down all the avenues, but gold is also an avenue.
Well, gold is, as Ronnie pointed out earlier on, it's already very difficult to buy gold if you're a financial institution. And we keep coming back to this thing. Most of the wealth of the world is tied up in regulated financial institutions, and it's very, very easy to stop them owning gold. Very easy to stop them owning gold. Now, whether we ever get to the stage of I ban you from owning gold is a different issue. Maybe that will come. But for most of the savings in the world, it's simple.
I see.
I mean, in Germany, I think 2,000 euros is the limit for buying gold without showing any ID. Over here in Austria, it's 10,000 euros, but it's going down every couple of years. So that's definitely also another form of financial repression. Russell, coming to an end, as I mentioned at the beginning, you founded the Library of Mistakes. So what would you add to this library if you think about, what's happening at the moment and what happened last year? What would be the biggest mistake? And I don't know if you if those are also kind of funny things or of those are I mean, today I just read that the head of this agency that is selling Austrian government debt, he said, I cannot 100% rule out that at some point we will sell Austrian government debt at positive yields. So I thought, well, it's pretty funny. I mean, 5 years ago, nobody would have expected such a statement, but now it's really pretty contrarian, it seems. What would you add to the Library of Mistakes?
Yeah, so the Great South Sea Bubble, which I think was kind of one of the early ones, not the first. I remember reading about it, and one of the great jokes through my entire career is that somebody once set up a company, and it was a prospectus, a listing prospectus, that said it was a company that was to be so secret that nobody was to know what it was to do. Well, that's a SPAC. And for my entire career, we just thought that was ridiculous. We'll never see anything like that again. And that's a SPAC. I discovered last week that there's a new SPAC called Another Acquisition SPAC. And there is now going to be an ETF called the FOMO ETF, the Fear of Missing Out ETF.
And there's the Vegan Climate ETF, Russell.
So I think these are things that we will have framed and put into the Library of Mistakes. These are the sign that in those assets anyway, I think we're well and truly in a bubble. That's not the same as saying we're a bubble in real assets, but in those assets, I think we're there. By the way, I think today will go down in history as one of the greatest mistakes in the history of Europe. Yield curve control, in my opinion, is a disaster for Europe. And it may take many years for that disaster to unfold, economic, political, social, but this is the biggest mistake that I've ever seen by a developed world central banker. I've seen lots of bigger mistakes by emerging market central bankers, but this one really takes the biscuit, and it's really quite frightening. So sadly, and I do mean sadly, I think yield curve control by the European Union, I mean, I'm sure others will follow in due course, but it's a sad day for everybody when this is where we've got to. So the others are humorous. This one isn't.
I agree. Russell, thank you very, very much. We really enjoyed it. I hope you did too. We promise, if you should come to Vienna once this is all over and we're allowed to travel again, we will host you for Schnitzel, for Apfelstrudel, for good glasses of wine, and for the tour through the Austrian Mint that I promised. Be our guest. Thank you very much, Russell.
And don't forget the beer.
No, I won't forget.
We won't. Thank you. Thank you very much.
That was fantastic. Thank you very much, Russell.
Okay, good luck.
Keep up doing such a great job.
I mean, did we cover anything that you haven't covered in your recent videos? You must go over the same conversations over and over again, don't you?
No, I think, yeah, similar topics, but hearing it from you is always better. So thank you very much, Russell.
Well, best of luck, guys.
Thank you very much.
Best luck to you.
Take care.
Best luck.
Thank you. Bye-bye.